Hi, my name's Michael O'Leary from Buy the Book Taxes, and I am here to speak about some tax resolution options available to taxpayers. Over the last several weeks, I've been talking about the IRS collection process. What do you do if you start getting letters from the IRS? What does tax compliance mean? Now we're at the point where for a client who has some debts, now we want to try and resolve them, okay? So we're going to look at three resolution options today, an overview of them. There are actually four ways to resolve your unpaid tax debts. Installment payment agreement, currently not collectible, offer in compromise. Those are the three that we're going to give the overview for today. The fourth is bankruptcy. Not going to talk about bankruptcy today. Pretty complicated. If you think you're a candidate for bankruptcy and you have some tax debt, you should consult a bankruptcy attorney first. There's a list of about 9 different variables that you have to satisfy in order to resolve or wipe out tax debts through bankruptcy. And that's only income taxes. You cannot discharge payroll taxes, for an example, through bankruptcy. Okay, so let's look at these three options we're going to talk about today. The first is the installment payment agreement. An installment payment agreement is basically when the IRS is converting your balance due to a loan. You would go with an installment payment agreement when you have the ability to pay the IRS back within the time frame that they are allowed to collect the taxes, which is 10 years after assessment. Typically, the installment payment agreements you see now run either 6 years, 72 months, or now, as long as you owe $100,000 or less, they'll go up to 7 years, 84 months to pay it back. There are some forms you may need to fill out. The form number is 433. It comes in a couple of different flavors. It's basically a personal financial statement that very similar to what you would fill out if you were applying for a mortgage or any type of loan. They want to see what your income and living expenses are. They want to see what your assets and debts are. And they're trying to figure out how much money is left over after all of this to pay them back. And if you do have sufficient income that will allow you to pay this back, they'll put you on a plan. The best thing to do is to set up an electronic debit payment on the 15th of each month. I don't like to set up clients on the 1st of the month because they pay mortgage or rent then. So I like to get it set up on the 15th, and then it just kind of goes on automatic pilot, just like any other monthly payment. It probably takes about a year for you to acclimate to it. And, it's just like any other monthly payment you make. So that's an installment payment agreement, like a loan from the IRS. The next option is called currently not collectible. This is when, due to certain circumstances, a taxpayer does not have really any money left after covering their basic living necessities to pay back the IRS. Typically, I see these situations where you have someone who has lost their income due to unemployment, significant medical bills, divorce, and also possibly the death of a spouse. Similar process. You fill out the form 433, basically showing that after you cover your living expenses, there's really nothing left. You don't really have any assets to sell that you could use to pay down the debt. It's really a hardship application. And if that's the case, the IRS will grant you this status. Typically, they'll check back in with you in about 12 to 24 months to see if your situation has improved. Maybe you've remarried. Maybe your illness is over and you're back to work, so that now you have the income that can be used to pay back the debt, and maybe you can get on an installment payment agreement. Okay, the last one is the one you're probably most familiar with, but it's not well understood, and it's the subject of all those TV commercials where they're asking you to call the 800 number. Excuse me for a second. It's called the offer and compromise. The most basic way to explain it is with an offer and compromise, you are settling your tax debt with the IRS for less than the face value of that debt. So let's say you owe them $100,000 and you make them an offer to pay $25,000, and based on your financial situation, either they accept it or they reject it. Now, one thing to understand, about 2 out of every 3 offers that are submitted are rejected. The reason being is that even many tax professionals do not understand how to craft an offer and compromise that will be accepted. The IRS uses a specific formula they call reasonable collection potential, or RCP, to determine how much the taxpayer can afford to pay, and as a result, how much the IRS should compromise. We're going to go much more in depth into this in a future presentation, but basically, the IRS looks at the assets you have, and are there any assets that are not essential to earning a living or living? They want you to sell those assets and get whatever money you can for them. Then they want to look at your income and figure out how much money is left over each month to pay them. They take, depending on how you file for an offer and compromise, there's a couple of different ways. They look at either 12 or 24 months of your free cash flow after your expenses, add that to what you can yield from the sale of your assets, put those numbers together, that's your offer. If you make an offer that is much less than that, it'll be rejected. If you have the ability to pay your tax debts in full, your offer will be rejected. So we'll go into this in a lot more detail over the next few weeks. So I mentioned that here. And then just in closing, I'm going to say, if you or anyone you know has unpaid tax balances, you're getting letters from the IRS, or years of unfiled tax returns, please reach out to me. Here's my contact information. I can help. Thanks a lot. See you next week.